Welcome back. You're watching the Wednesday edition of Business Morning on Channels Television. Of course, on the program today, we'll be talking about the decision by the Monetary Policy Committee to keep rates unchanged, the monetary policy rate, of course, and the cash reserve requirement, as well as other key rates that they talk about unchanged, they maintain status quo. So we'll be talking about that on the program and the implications, of course, for the economy, as well as how international investors will handle this decision. Joining me on the program now is an economist. He's also the chief executive of Financial Derivatives Company Limited, Mr. Bismarck Rwani. Thank you so much, Mr. Rwani, for coming on the program.
Good morning, Harriet.
Good morning. Now, at a time most central banks across emerging markets have cut interest rates as economic growth slackened, why do you think the MPC decided to maintain status quo?
What were the options? Basically, before we start, let's look at what was the condition, what were the monetary conditions before the meeting. The Central Bank of Nigeria was dealing with 5 major considerations. 1, mixed growth outlook for the rest of the world. IMF had cut back on and revised downwards growth for Africa, for the rest of, and even for Nigeria from 7 all the way to 4.8%. Clearly, that was one consideration. Second consideration was that our reserves are depleted, marginally to $34.4 billion. Inflation had actually spiked up a little bit, or stayed flat at 8%. Now, we also had currency pressures, volatility on our currency markets. Over and above that, we had oil prices down at about $48 all the way down. So between November, when we had the last meeting, and yesterday, the measures that were taken in November were pretty far-reaching. But the time between measures and impact on the market, it takes almost 60 to 90 days for you to feel the full impact. We're just at day 60, and therefore the central bank had to digest what had happened in November and see whether any moves at this time will be either precipitate or an overkill. But more than anything else, you must know that JP Morgan put us on negative watch. And therefore, you are dealing with domestic investors who were nervous. You are dealing with international investors who were watching very closely. And you're dealing with election uncertainties. That happens in every election, 3 weeks to the election. So if a central bank was to make any move, it would be wrongly misinterpreted as a political ploy. So the natural thing to do, 3 weeks to election, even 6 weeks to an election, even 12 weeks to an election, is that central banks stay neutral. They don't change anything, so that you don't create a stampede. Central banks are not in the business of creating panic. They're in the business of calming nerves.
No, so then you mean this? You think that this current policy stance will calm the fears of investors, despite the strong factors that we have at play?
No, the intention is to calm the fears. Whether people's fears are calmed, right, is another story altogether. But at least the intention and the signal that was being sent was that, okay, we can do this, we will do that. And the word that was going through all along was legitimate transactions. So for legitimate transactions, there is liquidity. For legitimate transactions, there will be stability. For legitimate transactions, therefore, if you start emphasizing legitimate transactions, therefore you're already implying that there might be illegitimate transactions. That's another issue altogether.
So apart from the fact that we have the rates maintained at where they are, could the Monetary Policy Committee, for instance, have decided to increase the net open position for banks by maybe 900 basis points? Currently, it's at 0.1%. And, I spoke to a couple of analysts, and they still feel that this is not going to do the market any good. So maybe they should have increased the net open position for banks by maybe 900 points.
No, the thing is that you're going to, first of all, they put us on negative watch. The risk you run is by increasing it, say, from 0.1 to 1, which is where it was before, is that you do that and say it's not enough. So the next thing for the central bank to do is to engage JP Morgan, the index administrators, and say, look, you say there's no liquidity. Please, there's liquidity. And the guys say, okay, show us that there's liquidity. Show us that there's effective liquidity. And then the central bank has to come up and say, this is what it is. At that point, you can then say, okay, we'll move the open position to 1%, maybe 2%, and then we see whether there can be convergence of rates. There are many things that go into exchange rate management. It's not just the open position. Exchange rates should converge. rather than diverge. When you have a difference of 25 naira between the parallel market and the rate, that's what we call a round tripper's paradise, right? There will be financial osmosis between markets, and people begin to move around money and make money.
Yeah, because I was wondering,
nothing.
you know, looking at the implications on, you know, on the currency market now, for instance, how badly will it be? How bad will it be? Because at the moment, the naira is still under pressure. Yesterday, at the interbank forex market, we saw the naira close almost close to 190 naira to the dollar.
No, actually, it went up to 191 and came back to 189 and all. The pressure will continue. It will continue because there is a fundamental issue about whether the naira is adequately priced. But you cannot do anything about it as a policymaker 3 weeks to an election. It's not just, first of all, it's politically inexpedient. Secondly, it will be misinterpreted. And thirdly, there are so many moving parts. So all the policymaker is going to do is to manage the situation, engage JP Morgan, because the bond index, the emerging market bond index is extremely important. If we get delisted from that, that's a kiss of death.
So that's a serious minus for the economy if that happens.
Oh, absolutely. You need it as much as a bullet in your head. And that's what it is. So we have to be on that index. Because if they remove, we are 1.12% of the index. If we are delisted, then automatically everybody sells the Nigerian instruments. When they sell the Nigerian instruments, they will have to we now have to look for dollars to give to them to take it out. So one, the bond prices come down. Secondly, the naira comes under pressure. And thirdly, when people see other people going to the door, they would also move. So the thing about hot money is that when it comes in alone. When it goes out, it takes a lot of people along with it.
What about our own domestic market, or domestic bond market? How badly would this also affect?
The domestic bond market in Nigeria, with all due respect, is not that deep, right? But we have a significant portfolio. The real problem is not the Nigerian bond market. The real problem is the foreign exchange that goes out. Because when we were included in the index in 2012, November, we got in over $2 billion came in. So arithmetically, if you exit the index, it's not only $2 billion that will go out. It'll be much more than that. So if we say, just for sake of argument, that $3 or $4 billion goes out, your reserves are 34. You take $4 billion out of 30. If you take your forward commitments out of that, you'll be looking at reserves of 27, 28. That could happen.
But if that happens, and then the CBN continues to draw down on those reserves to boost the naira at the interbank forex market, where does that leave? No,
that's playing with mirrors. You see, you don't deal, the way to deal with a currency, you try as much as you can, but you can't catch a falling knife. The reality is that you have to adjust at a particular point in time. What I'm saying is that you can't adjust it before an election. But after the election, you have to look for the fair value. The point, what is happening is that the demand for the dollars is more than the supply that we have. Therefore, you have to adjust the price. That is a natural, that's zero.
But that will be after the election, because you see, there actually had been this debate that, you know, probably the CBN at this meeting should have, you know, devalued the naira further, either plus or minus up or down.
No, it wouldn't change anything. You see, because the path, what you're looking for is a path, real equilibrium exchange rate path. You have to get into that path, and you have to accept that there will be two things are open. One, convergence of rates, desegmentation. I suspect that later in the year, we are going to scrap this RDAS. Because it's a ceremony that does not achieve nothing.
Well, scrapping the RDAS, will it have any strong impact?
No, basically what it means is there will be harmonization of rates. The central bank will be a trader in the market. The central bank will sell to banks at the rate at which the market is trading, and the central bank will buy from the banks. So there will be one unified rate, right? And the entire regulatory arbitrage and what we call price discriminating monopoly will stop. That's what happens in every other country.
But I thought that was the reason why the RDAS was reintroduced and the WDAS was taken out.
No. Let me tell you the normal transition of markets. You go from allocation, right, to retail auction. From retail auction, you go to wholesale auction. From wholesale auction, you go to interbank. And from interbank, you go to full convertibility of current accounts. What it means is that wholesale auction means the banks are buying for their position, and the banks can sell to anybody. If not, it's administratively cumbersome for the central bank to be dealing with Harriet's demand, this other man's demand. You know, it's a mess. No country runs that way. The currency, look, last week, the Swiss franc went into some gyration, and it gained over 30% against the euro. In other words, the euro lost 30% against the Swiss franc. The war didn't come to an end. The euro today is trading at about maybe $1.18 or something, compared to be 146. The pound used to be 163. It is now 150. So against the basket of currencies, the naira has not crashed. It's against the dollar, but we must differentiate between dollar strengthening and naira weakening, right? So currency adjustment is not a disaster. It is natural. If you look at all the other African countries, you see that the currencies have also come under pressure. Nigeria is only 11% down officially. In some countries, they've done as much as 30, 40%. The Russian ruble has done 70%. Iranian currency, Venezuela, right? And these are oil producers. So we shouldn't say that this is what an efficient central bank would look at the conditions which they have seen. They've looked at it that they shouldn't do anything in the midst of an election. And then after that, they were bold enough to take some steps in November. Was it adequate? Yes, at that time it was adequate. But now it has shown that it's inadequate. Some further steps have to be taken. And I'm sure they will take it. But the picture is not rosy. Let's not deceive ourselves. You see, this is what the X-ray is showing. And this is what the central bank is a doctor who is going to have to come up and treat this ailment.
So apart from the currency market, of course, we know that this will have an implication on the equities market, even though, you know, prior to this meeting, the equities market has seen a lot of bearish trading. You heard me talking to the stockbroker this morning. Up until Friday, the market had really taken a very strong beating. Yeah. On Friday, it gained. On Monday, we saw another marginal gain of 2.54%. Yesterday, 0.15%. But this decision now by the MPC, how much is it going to affect sentiment at the equity market?
The correlation between oil prices and Nigerian equity markets is unnatural. There's no relationship at all, right? Because when the oil prices were going up, the equity markets didn't go up. So I don't see why the oil markets declining sharply should take the equity markets. There is some tangential relationship. Therefore, we have to decouple oil prices from the market sentiment. Now, we've seen overnight rates in the money market down to 6%. The lowest point, the floor used to be about 10%, went down to 8%, now it's at 6%. At that point, the yields, dividend yields they're going to be getting from stocks in Nigeria will be far in excess of the money market. I suspect that a lot of money will go from the money markets into the equity markets, creating demand, because equity markets have been shredded. You know, when you see First Bank at 7, 8 naira, when you see GT Bank at 20, 21 naira, from a high of 30. So there's a lot of hidden value there. The uncertainties will continue in the stock market because of elections and all of that. But the moment the elections are over, and we can establish what we call a bottom, then selective stocks begin to actually appreciate in value. There's a lot of hidden value in the stock market at this point in time. But the sentiment is negative. The market sentiment and economic sentiment in Nigeria is negative. People are afraid, people are anxious, people are nervous, they have jitters. And these things will not disappear until after February 14 or February 21.
Everything just seems to be tied around the elections.
Yeah, so again, like Donna Ronsford said, when the unknown unknowns are more than the known unknowns, there's paralysis. People vote in favor of their fears. They hide their money and they get ready to take off. When the known unknowns now become more than the unknown unknowns, then people bring out their money. In other words, in this situation, what you see is what you get. And in this situation, what you don't see is what gets you.
Mr. Rewani, let's take a quick break, catch our breath, and come back and continue this conversation. When we come back, we'll take a look at how this decision might likely affect the inflation rate. Of course, I know that a lot of analysts have actually predicted that by January, we should see an increase in inflation rate, but we'll talk more about that in a moment. You're watching Business Morning on Channels Television, and we've been talking about the Monetary Policy Committee's decision to keep rates on hold. I've been having a conversation with an economist. He's also the chief executive of Financial Derivatives Company Limited, Mr. Bismarck Rewani. He'll be here with me in the studio when I return in a moment. Please join me again.